I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi everyone, I'm Jason Balara, and today I'm here with Andrew Rosenberg. I was about to say tonight because as of the recording time, it is evening, but I guess it depends on when people are listening. Andrew is an LP investor in over 3,000 units. He's the host of the CRE Spotlight podcast, and he's the co-host of the Simply Sundays Zoom Meetup, or a commercial real estate Zoom Meetup. Andrew, first, I just want to say thank you. Thank you for taking the time out. Thank you for getting this on your schedule and coming to talk to me.
Well, thank you so much for having me. Really been looking forward to meeting you and chatting with you, Jason.
Awesome. Why don't you start just by telling people about you? Tell us your background, kind of, I know in your bio it talks about family business, kind of, we'll kind of go through it. Being an LP in 3,000 units, that's a lot of units. So I love to kind of hear about your background and you know, sort of what brought you to the real estate space.
Oh, okay. I was very lucky. Went off to college and got a great job in corporate finance. It was a leadership development program. So you would get your MBA while working and traveling all over the world, working at different parts of a big company. And remember, this is like right at the peak of 2000. So of course, I was working at a tech company that no longer existed, but not much longer. So didn't like corporate and said, I really just want to go home. So I ended up coming back to Hawaii. And I was very lucky to be able to walk into a very successful family business. So it's a court reporting agency, and we basically provide services to litigation attorneys. So very nice, stable niche business. It's been very good to my family for 50 years. And about a decade ago, I realized, you just never know what the future would bring, and you should be investing for your family's future. And I've been investing in stocks for a long time, and while I like them, I don't like the aspect of it's not out of your control. So I started realizing, like, hey, let's do real estate. So we started doing real estate, and it's funny how over time it just kind of builds up. And I didn't really scale the concept well. So we got up to too many homes in too many states. And I said, okay, this isn't working. It's violating several principles. One was just, being happy. This isn't supposed to create a new job. So this isn't working for me. So we sold off, and, timing was good. We sold off before prices kind of came down just recently, and basically reinvested much of those funds into syndications. I still like real estate. I love depreciation quite a bit. I love rent. So I just didn't want to be the one handling it. So, that's basically the MO of how I got started into kind of being involved in so many syndication deals.
Sure. So the start of this, when you sort of started investing in real estate, that was more on an active basis, right? That was, you said, kind of single family homes around the country.
Yeah, I mean, I don't want to ever sound like I'm playing semantics, but there's just degrees of active and passive. There's no such thing as passive. I mean, once you own enough properties, even with property managers, if you own 12 properties and only once a year they have a problem, that means every month you're having a bad phone call from a property manager. In theory, it's not fun anymore.
Right.
No, I'm busy. I have a wife and son, and I have 3 crazy dogs, and family business we're trying to run. So I forego certain amounts of profit. I don't do fix and flips. We don't do heavy value add on the single family side. Generally, moved up the class scale. So I don't know if your viewers are familiar, you might make a lot of money in Class C property. You might not. You're probably going to have a lot of aggravation. You go to a Class A property, in theory, you should have a lot less trouble. You're going to make a lot less money. So,
Right.
as an investor, you kind of have to be honest with yourself, or what are my goals? What are my risk tolerances? What am I willing to put into all of this? So, now we're more of a B plus, A minus type of mindset in terms of my family background. So, we'll forego some of these big, home run deals. That's fine. We just kind of want to make a decent return. We don't go chasing, the big ones.
Yeah. Yeah. And I mean, some really great points there. Do, we've talked a number of times on the podcast just about kind of the knowing your investment thesis, right? What are you really trying to get out of it? And I kind of love that you started off that the whole thing with I stopped doing these active single family investing because I wasn't happy with it. And I think it's true, there's a lot of great things about real estate, and there's a lot of different components that you can work within, a lot of different asset classes, a lot of
Mhm.
sort of niches within those asset classes even. And so the good thing about that is there's a lot of opportunity, but maybe the bad side to that is it's hard to decide what is the right one for you. And then there are going to be some that probably don't fit with what you're trying to achieve. They may not fit with the lifestyle you're trying to achieve. They may not fit with, as you said, sort of your risk tolerance, right? The theory would be that as you move up in those, sort of class, from C class, B class, A class, that your returns might go down a little bit. But as you mentioned, the flip side of that should be a safer, more reliable
Yeah, I mean, in
return.
theory, you
Right.
can clearly screw up any, you can clearly
Right.
screw up any investment if you don't do your due diligence. Like, one of the things that I always find that strikes me funny, and it's usually with a newer investor. They'll find a city they like. They'll find, like, the neighborhood. They find, let's say, they like us, 4 bedroom, 3 bath. They know their price. They go in and buy it, and then they hire a property manager. And it's the funniest thing because the acquisition is a very small
Yeah.
portion of the lifestyle of lifespan of the investment. And most people's success is going to be heavily dependent upon the property manager.
Mm.
Unless they're doing, they're managing it themselves, or this is a flicks or flips situation. But most people that are long-term holders don't grasp the idea that all property managers aren't the same. You don't just take the top three and flip a coin and, spin the bottle and pick one. And what oftentimes you'll have is, and I met with an investor recently, and he'd said, I bought a property and I can't find a property manager. And I didn't mean to giggle, but I laughed a little. I said, what's so funny? I said, well, you screwed up the whole process. I don't need to know much of the story else. I already know you screwed up. And he's like, well, what do you mean? I go, is the whole order of the process you inverted. The first thing you should be doing is working with the property manager, because they're going to tell you, don't invest in this neighborhood. It doesn't rent well. It might look good on paper, but it's not really what happens.
Yeah.
Or, you bought a 5-2, you bought 5 bedrooms, 2 bath, but that's not what's really rentable in this market. People really want 4-3s. Or, you don't have no backyard. You say you want families, you want to be near a school district, but you didn't pick a backyard. Like, what were you thinking? And you went and bought the place already. Like, it's just
Right.
the whole order of the process is wrong. And unless you're going to self-management, manage it, or like you knew the area. But if you're a remote investor, the first thing you really should be doing is interviewing property managers. It's not just to pick the property manager, it's to learn the area. Who knows the area better? You reading US News and World Reports and a couple of websites like neighborhoods.com or something, or people who actually live in that area and they're going to be the ones that rent the building out. So they're going to tell you flat out, like, this is a C class neighborhood, this is a B class neighborhood. These are the rents you can get. Because what a realtor tells a remote investor, and what really happens in reality are few and far between.
Yeah.
We often talk about, like, the degrees of what I consider valid data points. So, like US News and World Report, I could care less. It's too broad, it's ridiculous. Things like CoStar and a lot of the software packages, okay, maybe. A broker's opinion, a realtor's opinion, unless it's a really good one that one you trust, that's obviously a very special relationship. I'd say 95% of realtors just give horrible investment advice. They sell homes, they don't know anything about investing, and you always have to discount by 20-30% whatever the rent they say you're going to get, because it's not going to happen for the most part, unless you have a really good one.
Right.
So the people that are going to give you the honest answer are the people, the boots in the ground. The property manager is going to be the one who's going to tell you, what are you thinking? That place is only going to rent for 1,200. I don't, the realtor might have told you 1,500, but like that's not realistic. That's not what we can, easily rent for you. And what a lot of investors forget is they're thinking, well, I just want to get the top dollar. Okay, well that's great, but while you're sitting around for 3 months, you're paying a mortgage. While you're sitting around for 3 months, you're paying insurance. God forbid you buy a property in the dead of winter and it sits for 3 months. Good luck you don't have pipes break or you don't have squatters breaking into the place.
Right.
These are all things that it's real estate's not complicated, but you can make it complicated by not respecting the process or doing things in the wrong process order.
Yeah, 100%. I mean, and all of that that you mentioned, you sort of used, I think, in relation to residential single family type investing, but the same thing is 100% applicable if we're talking about large scale apartment syndications. You still you need to have, especially that where you mentioned with remote investing, right? If it's not in your backyard, your team needs to be the first thing you do, not buy a property. So the property manager finding investor knowledgeable real estate brokers, whether that's the realtors on the residential side or commercial brokers, whatever it is you're trying to get into, you need to have those relationships. But still, as you mentioned, a lot of those broker projections are going to be definitely rosy.
Yeah.
And so you've got to be able to do your own research on the data.
Yeah, I mean, everybody's going to tell you it's a family friendly neighborhood, it's a lower B class. And then when a deal's going south, like on an apartment building, all of a sudden it's a rough neighborhood and it's a C class building.
Right.
It's just funny how we went from a low B to a C class, from the time of the acquisition to managing the property, or a nefarious one in commercial real estate would be, telling the investors, well, we had to fire the property manager, they weren't working out. That's all good, but you're the one who hired the property manager. So that excuse shouldn't fly with an investor. In a syndication deal, if you're familiar with like large apartment syndications, and a lot of times you're collecting anywhere from 1 to 2% of an asset management fee, and your job is to manage the property manager and to select the property manager. There's an acquisition fee. So due diligence is, would also fall. I mean, there's legal fees. There's reasons why people earn these fees, but you need to earn the fee. You can't later say, well, the broker told us we could raise rents $200, and we found out we really can't. We can only raise rents like $25. That's not going to fly. You collected a 1% acquisition fee. I invested. We invested our money with you. That's not going to work. The investors need to hold their sponsor teams accountable for what they're earning and what they're doing. It's not to say you shouldn't want to pay these fees, because you want them to be motivated to work on the project. Because if there weren't management fees, they just go on to the next project, right?
Right. Yeah. I mean, you want, as you said, you want those fees to be earned. You want them to be representative of the performance, right? It's
you want it
performance-based industry.
It's just tough. There's a lot of dirty secrets within real estate, especially on the commercial side, that people are always aware of. So like, one example is you'll find out later that the syndicator might own the construction company that did the value add. So the one that's going to paint it and put in the kitchens and floors. And your pitch that, well, it's good because we own the construction company, so we know the work will be done right. Then you start wondering, hey, wait a second. In that market, we'll just make a number. It should cost $12,000 a door to do bathrooms and kitchen. Let's just make up a number. And all of a sudden you find out it's like 20,000. Now you start wondering, are they pocketing 8,000 honest? Do they even care if the deal does well, or are they just making money off the construction? On the other hand, so a lot of companies now are bringing property management in-house because they don't want to trust a third party, which, it depends. You could have a really good property management team. They care about their asset and they want to make money. They want to have a good reputation with investors. On the flip side, you could have somebody who really is not doing ethical things. They could be putting off tickets left and right and not repairing stuff because they want that NOI number looking good because they want to flip the property soon. They want to sell it. And I don't know about you, but most investors get a better out. Most investors do not want to be slumlords. Most investors aren't, happy to be associated with that kind of practice. And these are things that do happen. I'm not saying they always happen by any means, but the level of digging that an investor in real estate would have to do to properly do due diligence on a commercial real estate transaction, it's much higher than most people realize.
Yeah, sure.
It's,
So,
it's not like just, you found a guy on YouTube, you like how he talks,
right,
write a check for 50 grand and you're good.
right,
I mean, you might be, but it's probably more lucky than good, right?
right, right. Well, and it's especially important now. I mean, we're just came through a market where it was hard to look bad because the market saved you. So you have to especially look for people that are really focused on performance at this point, given the way the market has shifted. So why don't, Andrew, maybe since you have invested as an LP pretty substantially, why don't you talk about a little bit like what you look for when you're
Oh,
deciding who to invest with, which sponsors? You don't have to name names. I don't care if you do, but it's
no, we won't. We
it's just
wouldn't.
it's a more of a what qualities are you looking for them? What kind of things do you suggest other people that are considering investing in syndication what they should look for?
Yeah, it's gonna sound like a cop out because everyone says it, but it really is true. If you think about like the venture capital model, it's not totally different from real estate. People are more familiar with it. The very first thing is the team, and the team. So you
Yeah,
don't bet on the horse, you bet on the jockey. So you really want to make sure that the team you pick, the individuals are all solid people, intelligent, honest, all these qualities, but work together well. And you're looking for track record. So you're going to want to know how their previous deals went. And this is an unpopular statement, but I'm not really one to mince words or, people like me, people hate me. It's fine. I am who I am what you see. I always look at if you're a first time syndicator or maybe even a second time syndicator, with exceptions, but generally speaking, go to your friends and family, get money, learn on their dollar. You're not learning on mine.
sure.
There's exceptions to this, of course. I mean, like if you've done a lot of um, smaller deals on your own and now you're doing a larger, I mean, that's different. It's not like you're a first timer, but if it's a doctor, a dentist, and a software engineer in Seattle, and they're buying a place in Ohio, and they've never really done real estate, really, that's great. Maybe they'll succeed. Maybe the property manager is going to do everything right, and they don't need to be babysat. And maybe the broker really did give them the right rent comps, and maybe the rents are just going to rise up, and maybe the expenses are all going to stay nice. Just there's a lot of
Right.
maybes on that. That's probably not where a first time investor wants to go. You need to move up the food chain, and you're probably going to want to go with like a large boutique shop, not quite institutional grade, because the minimums are going to be very high. Like if you're going up the food chain, a lot of those are going to be like $250,000 minimum.
Right.
And let's say you had $250,000 to invest. I, I would argue that most people would be better off doing five $50,000 investments than one $250,000 investment. And ideally it would be a mix of mostly multifamily, but maybe a little bit of storage and let's just say industrial. or
Sure.
some other asset class. And
Yeah.
and ideally you wouldn't do 5 deals in Texas. It's just not very bright. You probably want to pick maybe a deal in South Carolina, a couple in Florida. I mean, like maybe one in Florida, maybe a couple in Texas, and God forbid, something in the Midwest like Ohio or something. Just naming states. These are not necessarily my favorite states. And you would go with larger, more established guys that you can say, what were your last 5 to 10 transactions? How did they go full cycle? What were the returns? And that'll give you a better sense of these are the people that are a little more systematized. They have a full-fledged team. One thing you're not going to want to do is you're not going to want to invest with two people. Um, there's too many hats. Most teams are going to have a capital raiser. That's a person who's really good at raising funds from investors. You're going to have a person who's the deal sourcer, who's very good at either hustling off-market deals or good working with the broker, does a lot of the due diligence work. Usually you're going to have an underwriter. You're going to have a person who's running all the numbers, who's more financially savvy. And you don't want somebody who's just plugging it into a software. That works great in a bull market. I don't, we'll see in the next few years the guys plugging things into into software packages. And then lastly, this is where a lot of teams fail because no one wants to do this job, is asset management. No one really wants to be on the phone every single week, 52 weeks of the year with the property manager, fine combing all the reports and making sure, are we leasing up, checking their online, ratings. Are you popular on Yelp? Do the residents like the new pool deck? All these boring, mundane tasks. But where most deals fail when I talk to LPs, generally speaking, it's one of two things. Either right away on the due diligence, they screwed up, which isn't that common. Usually it's in the property management. Usually the rents don't go up, expenses are out of control. The turnover is just too high, or evictions are higher than necessary. And a lot of it comes down to that relationship with the property manager. So you're looking for a robust and full team. You're not looking for drone video footages or fancy websites necessarily, but you really want an established seasoned team with a track record. What's hard about it is there's a thing called 506B and 506C. And I know you're familiar with it, but for maybe there'll be viewers that don't know.
Yeah, no,
506B
good to clarify.
is I can only go after friends and family, but there's no limitations on their net worth or their income. So it's a double-edged sword. I have a wider variety of people I can go after as investors, but I'm not supposed to advertise. Now I'm talking about legally, and what really happens in the real world, well, that's a different story, but by definition, that's what's supposed to happen. 506C, I can advertise. I can go right on LinkedIn and I can tell you, hey, I got a property 3 miles from my house, 44 units. I know the property manager. 60-year-old guy ran it. He ran it terrible. He was letting his friends stay there. We're going to jack up the rents 300 a unit easy. Don't worry, we're going to make 30%, internal rates of return. That's okay if it's a 506C, but there's a catch. You have to now be an accredited investor. So an accredited investor falls under one of two categories. Either you have to have a net worth of $1 million, and it can include your primary residence, your home, or there's some income requirements. And I want to say, don't quote me, it's like 200,000 if you're single, and it's like 300,000 if you're filing as a married couple.
Yeah, that's
so
what it is.
Accredited investors are going to be doctors and lawyers and chemists and software engineers. And a lot of times on the small business side, it's going to be net worth of over $1 million. It's going to be people who already own a good amount of real estate, so their net worth is in excess of $1 million. So those are the two categories that you would have to understand if you're going to look into invest in a syndication deal.
Right. Yeah, and
most deals are 506B, to be honest.
Yeah, it definitely matters. Really, it matters for both sides, right? It matters for the sponsor, who they can bring into the deal as an investor, and it matters as an LP, which deals you can go into. If you're accredited, you effectively can go in any deal. But if you're not accredited, now you've got to go with someone that you have, has to be a 506B, and it has to be someone that you have a pre-existing relationship with. So there's
Yeah,
definitely some caveats as
yeah.
far as being
The
able to get
SEC
in.
creates kind of a problem because there's a lot of really good investment groups out there that don't want to get in trouble.
Right.
So they don't advertise. So now you're a new investor. How do you know to, contact Mike Smith? Because Mike's rocking it. He does a great job. He's got a really good team. He's got good returns. Reports honestly to his investors, takes care of them. But you don't know him. How do you find him out? So this is where the research comes in, where you're going to want to be on a platform like a LinkedIn, and you're going to want to meet other investors and ask them questions, and who do you invest with? And there's online meetup groups where they break into little breakout rooms, and they'll have 4 people in a room, and people kind of introduce and say, hey, I'm this guy. And if somebody comes in and says, hi, I'm a 48-year-old dentist, I make a lot of money, but I don't want to be managing properties anymore, and I really like storage, and I just want to start investing in storage. A guy like me will be on that call and say, hey, have you met so and so, or these people? And if not, would you like me to send a DM and put you and this person in the same DM, and we'll introduce you. That's generally how you're going to get the better investments, to be honest, is through referrals. So like for me, some of my best investments were referrals. So the deal that I have that's probably one of the more profitable deals, specifically, I contacted a friend who's a much higher net worth than I mean, much, much higher. And I just said, hey, I'm having a little trouble. The last couple of deals I didn't really like, or I'm reviewing a lot of stuff, but I feel like I'm spinning my wheels. Do you have any recommendations? And he said right away, hey, I got a deal that'll fit what you like. Is it okay if I send a DM? And I said, yeah, sure, send a DM. So he introduced me to a gentleman, and I ended up investing with them, and it's doing very, very, very well. So that's what you learned, is like the first investments I did, it was a good start, and it got me on the right track. So it got me seeing, distributions coming in on my phone, and seeing it in my bank account, that kind of thing. But I learned quickly, like, okay, it's time to go to the next level of investing. There's better sponsors out there, and the only way to find it is to really do the networking.
Yeah.
Or,
Yeah.
the best thing is ask. I mean, really, just ask.
Right. It's absolutely true, and it again, it's true on both sides of that equation, right? It's as someone who wants to invest as a limited partner, you should look for referrals. You should sort of ask around, see who the best sponsors are. As a sponsor looking to raise capital, you're going to ask your investors that have had a good experience, and you work closely with them. Do they have anyone that they might know that wants to invest? So it kind of goes in both directions, and there's certainly benefits for both sides, really, in terms of getting the opportunities out there. I think it is a system built on really requiring networking, because of some of those SEC regulations. It's just, you can't just always advertise it. So it's something that you do have to be careful with, and something you have to then therefore try and meet as many people within the industry as you can.
Yeah, it's not like like a mutual fund. You can buy a magazine or go to a website, and they'll show all the performance metrics and the fees, and everything's relatively standardized. And they're going to break them down into large cap, mid cap, small cap, value, growth, international, all these nice things. They don't have that in syndication land.
Right.
That you don't. There's no website you can go to that's going to say these are the top 10 smartest guys in the business. You're going to have to figure it out on your own. No one's going to hold your hand too much. I mean, you'll figure it out. You start realizing, like for me, there's 2 gentlemen that they've owned a lot of syndications, more than I do. I'm usually going to them for advice. Like if I meet somebody, I like the deal, I might review it with them. Even if they don't know them, they'll take the time, just like, well, did you think about this? What about that? Or, well, that sounds good, and we'll go over we'll sounding board it together. Those are the relationships that really drive better performance over the long run. it's just tough. Like a lot of viewers get kind of, they get sold on a dream, retiring early and financial freedom. And they watch this video and everything's great. And they're going to make, they're going to double their money and it's a sure thing. And, in 2 years. And that's not really reality. You know, the last, several years, you know, we saw unbelievably, historically inaccurate growths in rent. And I think you could slap a coat of paint on it and sell an apartment building for more the next year, right?
Right.
But those days are, we're pretty sure those days are few and far between. The best operators are still going to make money. In any market, there's always inefficiencies. There's going to be this off-market property that was badly managed, and a really good operating team is going to come in and, they're going to do simple stuff. Like they're going to change all the toilets and lower their water costs, and immediately the value of the place went up. They're going to swap out all the light bulbs and lower the electrical cost. All the faucets, and they're going to aerate them so they don't use as much water. Just simple things like they're going to fix the signage, rename the building to get rid of the bad reputation it might have had. Reseal a parking lot. Simple things. But these are all things that create value to a property. I think one thing that a lot of investors can't grasp, and it's bizarre to me because it's a very simple concept. You don't value a single family home the way you value an apartment building mathematically. Mm-hmm. If you're looking at homes, it's largely comps. You can do all kinds of stuff. What are you really going to do to really raise the net operating income of it? It's a home. It's going to be valued on a comp. Apartment buildings are not really valued on comps. They're valued on net operating income. So you have a building that has a storage issue, let's just say, and you put in storage lockers, and now you're going to charge residents for the use of the lockers. You just increase the value of an apartment building. You're not really going to put in storage on a single family house. And how much more rent are you really going to get? And when it comes time to sell the place, okay, it's nice. You added a little storage room, but they're just going to say, well, the house down the street, that's the comp. Right. It's a subtle difference, but it's one that most investors don't grasp.
Yeah. I mean, yeah, the valuation of a residential home sale is just entirely based on comps, right? Because it's not income producing. Maybe if it's been used as a rental, or maybe when you're talking about like short-term rental type properties, that type of, you could argue that it's going to be based somewhat on the income. And then your larger commercial assets are going to be valued based on that NOI or the performance of the property. This is something that I think is interesting, because I think the point that you're making is true and valid, but there is one little caveat to, I think, that throws a little wrench in that theory. I've heard other people say the same thing. Cap rates. Okay. So cap rates are the comps, realistically, right?
In a sense,
in a way, I know it's not exactly the same thing, but if you're looking at, okay, what are the cap rates in this market? It's gonna, for this particular this particular class.
The cap rate, you're right, is the sense of what you can't control, I guess, if you're going to call it a comp. But I mean, you have control over the NOI on a commercial property versus, you take away, short terms or Airbnbs, but like, that's the difference on a single family home. It's entirely comp based. There's not really an NOI.
Oh, yeah, absolutely. There's no opportunity. I guess if you flip a house or something like that, you're increasing the value based on but it's still based on the comps. It's still,
it's based
I'm turning this house that had, it was trashed. Now I'm putting in nice cabinets and countertops so that
I furnished the basement, or I added a room, or we redid the roof, but you control the NOI, to some, so with some extent, that's what you can control. So even if the cap rate went unfavorable to you, there's you can do the math on it. But like, if you raise enough, if you're doing everything right and you're raising rents, you're lowering expenses, historically, you're going to do well, even if the cap rate went against you, because the NOI is really what drives that property, especially the bigger units. Like, just saving $25 a month in electric on a building. If you have 400 units, all of a sudden that's a lot of money.
Right.
It's just tough you can't scale that like on a house. It's just a lot harder. Like,
Yeah.
me putting in energy efficient appliances in a home, I'm not going to get a big return on it. I swap out all the ovens in a 400 unit apartment building for lower electric using ovens. Obviously I'm going to get a bigger savings. You know what I mean?
Right.
The other thing that investors have a real hard time grasping, it's just bizarre to me, but the debt are totally different animals.
Mhm.
Single family home. I love single family homes debt. 30-year fixed is like the greatest thing in the world. I mean, it's other than indoor
Yeah.
plumbing or maybe sliced bread, it's like the third greatest thing in the world. I mean, you're going to tell me that if I told you there was this company and their largest expense was going to be fixed for the next 30 years, but inflation was going to happen and the revenues were probably going to go up, you'd be banging down my door, blowing up my voicemail, trying to, buy that stock.
Yeah.
That's single family
Sure.
homes. I
Yep.
mean, it's kind of a bizarre thing why people are more excited. I have a hard time. You'll get it, but I mean, some people won't, and that's fine. I often tell people the asset is the loan and the house is the liability. And they look at me like I'm insane. And I said, but you're not grasping it. Like a 30-year fixed rate loan, if you got it 2 years ago at, let's just say 3%, in a 9% inflationary world, or 8%, whatever CPI is now, you're making hand over fist just off the debt. The debt became your asset. Whereas
Right.
the home, which one are you going to have variable expenses? The home, you're going to fix the boiler. You might have to repair the roof. The tenant's gonna, when they move out, you're gonna have to repaint the walls and maybe touch up the floors. That's actually the liability. What's the liability? The municipality, they might raise your property taxes, right? The insurance company, you never know, they could just raise your insurance bill a whole bunch because they're going to say global warming or climate change. That 30-year mortgage never changes. It's a fixed amount.
Right.
And if it at the right rate, not today's rate, but 2 years ago, a year ago, that was the asset. Whereas in single family, you're not going to see 30-year loans on an apartment building.
Right.
And
Yeah.
most investors don't understand like what really drives real estate. It's taxes and debt.
Mhm.
We're playing a shell game. Let's just call it what it is. I mean, it's the most tax favored asset, and it's the best asset for leverage. You can borrow money against stocks. They're not going to give you much a loan to value ratio, and they're very volatile. They're all over the place. Real estate, it's like a cruise ship. It doesn't really zigzag like like a little jet ski would, for the stock market. Banks like multifamily. When you talk to lenders, their favorite asset class is multifamily. They can get rid of you if Jason, you're running a building, you're not doing a good job, and you're in violation of your loan covenants. They can kick you out. They can get somebody to run it better.
Right.
Versus if your collateral is Bitcoin or some lousy tech stock, there's not much the bank can do. It's the collateral is the collateral, right?
Yeah.
So what most investors aren't getting is they'll watch a pitch deck and it just really it gets me angry. I'll be honest with you. They'll watch like slide after slide about the city and the beautiful photos and the ARRs and IRRs and equity multiples and just a bunch of nonsense, frankly. And then maybe they'll tell you about the debt, or maybe they'll just skip it entirely. And you're like, whoa, hold on here. Like one of the biggest drivers of success is going to be that debt. What is the loan to value ratio? What is the loan to cost? Is it a 3-year loan? Is it a 5-year loan? Is it a 10-year loan? Is it agency? What is the interest rate? I mean, like you as an investor, you're going to want to know. You wouldn't go buy a single family house and just tell your wife, we'll figure out the interest rate later. Right. Or
Right.
well, honey, you know what was great? Everyone who went broke during the GFC had variable rate loans. Let's do that again. Right. You wouldn't exactly
Yeah.
go sign up a home that you're planning on owning for decades and say, you know what, let's just run with the wind. We'll just let it be variable.
Yeah.
So why would you do that in single family homes? And you wouldn't. So in an apartment building, it's if you want to say, hey, I'm such an economic genius. I know what Jerome Powell is going to do, and I want to play a game that I think interest rates are going down. That's lovely if you want to do that. Frankly, I think that's stupid. Because if you really wanted to make money off interest rates, go buy the derivative. You can buy a futures contract, buy an options contract, go play the interest rate game. If we're playing the real estate game, I got lots of risks I got to deal with. I got to deal with possible fraud from a property manager. I got to deal with, is a new mayor going to come in and tax me a bunch? Are my tenants going to just skip out? Is there going to be a recession? I got lots of risks. I don't need interest rate risk. So one of the questions an investor should be asking in a syndication deal is, did you buy a rate cap? Is it a fixed rate? What are the terms? What's the amortization? Like once you watch enough deals, you're going to learn what's generally the standard. And is it 3 years interest only? So we got like 3 years to get our act in gear, and then all of a sudden the payments get a little bigger. If you're buying a rate cap, well, what's the rate cap? How is that going to affect the profitability? Because if you say the debt's, let's just say the debt's 5%, and you're projecting, all these lovely returns, and I ask, okay, but what's the rate cap? Well, rate cap's 6. Well, what happens if interest rates go up and we're at the rate cap amount? What are my returns now? A lot of investors are left to their own devices to figure out what the return would then be. The thing that you should be asking for is the sensitivity analysis. And they can, it's very easy for a syndicator to do. They have the software, the Excel spreadsheet. They can tell you, this is what we projected, but this is what the return would be. If we only raise rents by this percent instead, this is what the return would be. If we're wrong on occupancy and it's going to be more units are vacant, this is what the return would be. So you can start seeing your downside. You can also see upside. So, you could say, hey, the one thing we can't control is cap rate, like you're saying. And you're saying, hey, conservatively, we think it's going to sell 5 years from now at a 5 cap. What happens if it's at a 6 cap? We're going to make less money. I want to know how much less money I'm making.
Right.
And then on the flip side, like maybe we get really lucky and there's this great bull market 5 years from now, and cap rates are going to be 4. Well, I'd like to see that too. So you'd like to see that sensitively in between some people do it 50 basis points or 25 basis points, some range. So you can see like best case scenario, what we think is going to happen, a bad case scenario, this is what it means. Some people like me are going to want to say, just what's my break even? How many units need to be economically occupied for us to break even? Like at what cap rate in the future do I at least make a minimal return? Is it 6.5? Is it 7? These kind of questions. These are the intelligent questions that investors should be asking of a syndicator. And if they can't answer these questions, this is kind of your big litmus test for it's time to run. The other one is, don't be obnoxious. Don't ask a half hour's worth of questions. Or there's one guy, he had the 99 questions to ask a syndicator. You don't ask all 99. Frankly, that's crass and annoying. Right. But let's say you have 5 questions. If the guy's annoyed with you or the lady's annoyed with you for asking 5 questions, don't invest with them. Right. It's not a good relationship. They view you as a back to step on. They only see you as capital. They're not interested in you, Jason, the investor. So that's one of the criteria I'm going to have is, this is a long-term relationship. I mean, you're looking at anywhere from 3 to 7 years. 5 years is just kind of the quoted standard. That's a long time. I mean, how many people date somebody less than 5 years? And it's, you're scarred for life. Cindy was just the girlfriend from hell, and you just wish you had those 2 years back. Or, Pete was the worst boyfriend ever. And you're just, God, what was I thinking? I was with him for 18 months. Well, you could be with a syndicator for 5 to 7 years. And if you're calling them up saying, hey, it's been 4 months, like you said, we're going to get quarterly reports. Where's the report? And you're not getting it. You're not going to be really happy. If you're going to find out, hey, we had a problem with evictions, and that's why there's no distributions this month. You went into your bank account and you're like, hey, I was expecting my $250 in my account this month. And you got to call them up, and then they're telling you, oh, well, there's these problems. That's not the kind of relationship you want. You want the guys that are immediately going to call their clients and say, hey, we're having a problem. This is what it is. This is what we're doing to fix it. That's going to create a level of trust. And so different syndicators are going to have different reputations within the industry. So if you called me, Jason, and off camera and said, these are my criteria and this is my comfort zone, this is how I'd want to invest, I would say, okay, I'm going to give you these like 3 names to invest in.
Sure.
I'm not going to put a person like you with someone I don't trust, that they're not going to release full financials on a quarterly basis, that wouldn't call you right away when there's a problem. There's going to be problems. I don't care what syndicator it is, particularly in multifamily. There's going to be problems. People are weird. There's weather. There's governments do just goofy stuff. I mean, someone crashes into your apartment building. What are you going to do? I mean, weird stuff happens. That's really the key that I'm trying to get at, is like, it's a long commitment. It's not just the money. You're going to be very unhappy if you pick the wrong syndicator.
Yeah, it's a long. I mean, that's one of the. I think it's one of the good and at the same time maybe one of the negatives about syndication that people don't like is the illiquid nature of it, and so it's bad because if it's not going well, then you want to get out, but for all the reasons that you just stated, not necessarily because there's a bad thing that happens, because as you said, there's always going to be a bad thing that happens.
Yeah,
There's going to be problems.
Investors can deal with problems. It's the number one thing that's going to piss investors off is communication or trust issues.
Yeah.
A good example, and I won't get into specifics, but a good example that I know some investors, there's different 2 deals I can think of where it arguably wasn't communicated well, that there was going to be equity raises in stages. So some of the people that got in at the first stage, they thought that was the capital raise.
Mm-hmm.
And the syndicator thought they communicated there was going to be a further capital raise for construction. So the investors are like, wait, I'm on LinkedIn and I keep seeing these capital raises, like we already closed, what's going on? And then they're told, well, there's also a construction phase now. And that miscommunication issue creates a wedge between the investor and the syndicator, where even if the deal does well 5 years from now and everyone makes money, there's a really high chance that those investors will not be reinvesting with that person. So like there's 2 deals I know of, one I'm in, one I'm not in. But vis-a-vis, when I talk to other investors all across the board, all they were saying, I think I'm going to make money in 5 years. That's great and all, but I'm not recommending any of my friends to any deals this person's doing. And investors hold grudges. I'm going to be honest with you. We try not to be petty, and I don't blast anybody on. I'm not going to do it on a podcast, but we're not going to recommend somebody. It's my reputation. I'm not going to tell you, Jason, here's 5 guys to work with, and if I know 2 of them are, they're not going to do such a good job, I don't want you calling me in 6 months and going, Andy, why did you what did you do? Why did you recommend this to me? These guys suck. I don't want that, on my plate.
Yeah. Well, you want someone who is going to do what they say they're going to do and have honesty and transparency. I mean, at the most basic level,
that's simple, or you would think that that's
right.
It's not.
Mm-hmm. No, I agree.
Everybody's forthcoming in your friend in a bull market.
Yep.
We'll see the next 2 to 3 years. We'll see people's true character, come through. Who are really good people, and who are going to step up to the plate. We'll see. Right. There's definitely people that within my network of people that I know and like and trust, that if you said, hey, I want to do RV parks, the vacation RV parks, there's a group that I work with that I have full faith in them. I would tell my own family members or closest friends, hey, it's okay, go invest with these guys. Right. Or industrial or storage, different types of deals. The hardest part is people get this thing called shiny object syndrome too. They're looking for like the hottest new, fad or craze, and they don't really understand what they're getting into. Most people want to see quarterly or monthly things in their bank account. It's
Yeah.
going to give them some pause to think, okay, it's not a lot of money, but it's like an indication things are going well. And, things. Whereas other investors, a lot of the more sophisticated investors or like a higher net worth investor, they don't really care because like getting $500 into their bank account, it's not gonna move the needle if the guy's worth like $30 million. So they're going to be doing a different type of deal than you're doing. Or, frankly, I'm not a $30 million kind of guy. They're going to be wanting to do development deals. They're going to want to buy the land, prep the land, get all the legal done, all the documents with the court. They're going to get the infrastructure, build it up, rent it, get it rented, and then sell it. And this could take many, many years, but the payoff at the end could be quite large.
Right.
Very, very large, oversized returns. But you could go 5, 10 years without any returns. You might not see a dime of cash flow. For the average investor, that's just not going to work. And let's be honest, everybody talks a big game about being tough, and they're going to hold, and but they're not really. Most people are going to want to see some cash flow coming in. So you need to be honest with yourself when you're investing. A lot of people I know that have been unhappy, some of it is their fault. They invested in something and they didn't really align it to what their goals were. So if you're 65 and you invest in a deal in Houston, and it's a high value add deal that's never going to cash flow really, you're gutting everything. You're doing landscaping, you're changing out the parking structure, new signage and windows, and I mean you're doing the roof, you're doing the works.
Right.
That's probably not the best deal for a 65-year-old retired person that's going, oh, okay, I'm 4 years in, I've never seen a dime. They probably should have been in a storage deal. Nice, boring, cash flowed from day one, and some of them you can get a monthly distribution, some a quarterly. But if you're a 20-year-old, let's say you're 24-year-old and you're making a lot of money and you got lots of time on your hand, that storage deal doesn't move the needle. It's never gonna triple in price. You're never gonna get a big home run out of it. And for the 24-year-old chemist, maybe that's not a good choice, but that's what all his friends told him to buy, right? So there's a level of education beyond just due diligence of others. There's almost a level of due diligence of yourself. There's so many deals out there. You can find what suits you.
There'll be something that fits your.
You don't go chasing the first. Just because your buddy made 20% IRRs, with the syndicator, doesn't mean you should invest with them. It might not be a good fit for you. That's kind of where I'm going with. That's a short version.
Yeah, it's absolutely true. It's the you have to know what your own investing thesis is, what you're trying to get out of it, what you're as you mentioned, some people really care about the cash flow. Some people just want, kind of the big return at the end of the day. Some people just want the tax benefits. I mean, it's really, there's definitely different focuses for different investors. So you have to know what that is for you. I mean, that ultimately at the end of the day, if you're investing in any asset class, real estate or otherwise, you really have to know what your goals are, what you want to get out of it, what your risk tolerance is, kind of all of that has to go together.
We do one little bit is it's kind of like it's a dirty little secret about commercial real estate, but it's not really dirty. It's just something that it can be made dirty by people not being forthright. Is that okay?
Oh, sure. Yeah.
Okay. There's a thing called an equity backfill. So what really happens in the real world, and it happens a lot, and it depends on who you are. There's guys that are super ethical and forthright about it, and everything's kosher. And then there's guys that spin. Spin pisses me off. Spin is, I'm not working with you ever again. I'm not recommending any of my friends to you. And spin doesn't mean that it wasn't economically viable or legal or even ethical. Spin just doesn't work for me. So let's just say, Jason, you're a new syndicator. You buy a 44-unit building, let's just say in Los Angeles. You found a great deal. And let's just say it's a $10 million building. So the bank's willing to give you $66 million. They're only willing to go to 60% LTV. You're a newer syndicator, it's 40 units. They're scared, right?
Sure.
The economy's not going so good. Still a good deal. So you're going to raise $4 million. let's say you've got 1 million of your own money. You're a wealthy guy, Jason. You look like a pretty wealthy guy. So now you got 3 million more to go, right? Let's say you've raised $2 million, but you're coming close to the wire. You're missing 1 million. What are you going to do? You got a $50,000 earnest money deposit with the bank. You're going to lose this money if you don't close the deal. But you're $1 million short. You got like 2 weeks to go, and you did good. You raised 2 million. You brought in 1 million euro, but dang it, you're $1 million short. Now you're also worried about all your investors are going to be pissed off because I gave you money 3 months ago. I passed up some other opportunities. You giving me my 50 grand back is, let's say it was a 50 grand minimum. I wired over the 50 grand to Lark Capital. I'm not going to be in a good mood, Jason. We're going to have some words, me and you. If 3 months later, 6 months later, God forbid, 9 months later, you're calling me up and saying, hey, we've been negotiating, deal's not going through. I'm mad now with you, Jason. We're not investing. We're probably not going to be investing again. It's probably going to be bad mouthing. So you're now really motivated. You got $1 million. You're short. You got to raise this money. What are you going to do? So you're going to go to Ethan Gao. He's a gap loan lender. And he's basically going to tell you, hey, I'm going to stick it to you. And you're going to have to take it. So you're going to say, hey, I need you to write me a check for $1 million. I need to close the deal. He's going to charge you 18% interest, 20% interest. I don't know. It's going to be a lot. And he's going to charge you a whole bunch of fees. You're going to say, okay, I got to do it. It comes out of my pocket. It comes out of your pocket, Jason. I'm sorry, not my pocket. So you're taking care of your investors. You're closing the deal. You're the only one suffering from paying some fees and a lot of interest. Your job now is to raise that $1 million. Deal's closed. You've taken over the project. It's been de-risked. You go to me again and say, hey, Andy, I want you to invest. The deal's closed. Now I don't have to worry about the deal not closing and you returning my money. The deal's closed. A month into it, hey, Andy, we still have open spaces. We want to sell you the equity. We're already raising rents. Turnover went well. We didn't find any, hidden things. Once we acquired the property, we didn't find out the boiler suddenly died. Everything looks good. You're coming in de-risked. You're happy. I'm happy. The lender's happy. I come in, less risk on the deal. You're happy. You're getting the equity, to do your backfill. Lender's happy. You're paying them back off. Ideally, 2 to 4 months. You raised all that $1 million equity. All your, the initial investors, the deal closed. Deal's going good. They're happy. You got to save your reputation. You didn't lose the $50,000 earnest money deposit. Property's going great. The grand scheme of things, it was only 2 months. It wasn't like you paid the whole years of interest. The fees and the grand scheme isn't that big a deal. You're making money. That's something they don't tell you about. So what'll happen is a guy like Pete comes to Andy and says, hey, Andy, do you want to come in on a deal? We reserved some shares for VIPs. No, you didn't. You're backfilling equity, bro. Don't tell me I'm a VIP. Go after yourself. Let's, I'm trying to keep it PG-13, but you're lying. You're not telling me the truth.
Yeah.
We're doing you a favor. We're going to take it out of our own, pocket. We're just, we're letting you in because we like you. I like you, Jason. You're a good guy. No, save the mafia pitch for someone who's not stupid. I know what you're doing. Some people will lend money themselves. Like Jason Corporation will lend Lark Capital money at interest, and then they're paying themselves back through that equity backfill. So just call it what it is. There's nothing dirty or nefarious about it. It's a common accepted practice in the industry. It happens all the time. There's nothing bad about it. I frankly don't mind the call. Call me up 2 months into a deal. I love it. I mean, I'm all for it. Like, I already know how the deal's going. I don't worry about months going by and then maybe the deal doesn't go through and you're wasting my time. It's not a problem, but just call it what it is. Yeah. That's the problem. So this is just one example, but there's many within the industry. You really gotta know what you're doing, because if you don't, you're gonna get taken advantage of. There's a lot of spin doctors out there. And the other hand, there's a gentleman I know. He lives in Massachusetts. I hope he's watching the video because he'll know I'm referencing without saying his name. when I told him this, he was just appalled. He was like, "Are you serious? People do that?" He couldn't even comprehend it because he was on a deal. The exact scenario that I'm playing out to you basically happened. And I was on a call with him with about 30 other investors, and he just flat out laid it out for the truth. Tell him, great property, everything's going well. We had a little bit of a shortfall. It wasn't that much. I think his shortfall was like hundreds of thousands, not like a million.
Right.
Basically, we borrowed money from somebody to close. We just want to get him out of our life, pay him back. And do you want to come in and bring equity? And he just told the truth. God forbid, just told the truth. He had no problem raising the equity. It was a really good deal. It was in Ohio, close to where they're building a new Intel semiconductor plant. The property's going to do well. It's going to make money. They're doing well. It's a well-managed property. So you're coming in on a going concern that's doing well. All he had to do was tell the truth, and he did. But there's guys that won't tell you the truth. Trust me.
Yeah. Yeah. It's honesty and transparency. Right.
Yeah. So,
right from the start,
right
right through the whole thing.
Yeah. When you get a pitch deck is basically just a glorified word for a PowerPoint presentation. If you're a newer investor, what you really should be doing is hopefully you've already made a friend or a coach or a mentor, at least a friend, or a couple of friends, and you would say, "Hey, I'm kind of new. I want to invest in this deal. Hey, Johnny, Cindy, and Pat, can you just take a look at it?" So a friend of ours recently did this, and I sent it to three guys that I really respect, their level of analysis. Three of them, two of them are operators. One's a serial investor like myself. I said, let's just do this guy a favor. He's a good dude. They all looked at it. They got back to me before I even had a chance to look at it and said, no, 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 no. And I said, oh, geez, what? And I said, well, I should probably go look at it. And I knew right away what it was. The syndicator didn't list anywhere in the slides the fees. We had no idea. We can't figure it out. And it's unheard of. I mean, I've looked through enough pitch decks. I mean, trust me, the fees are usually in the pitch deck. For it not to be in the pitch deck, you're like, what the heck is going on? And again, the debt wasn't in the pitch deck. So I mean, it's like, to me, it's like you're just so done. I told the friend, I said, look, the four of us are all just like, what on earth? No way in heck. Do not do this deal. Like, there's deals that we might say, it looks all right. If it's your friend or you feel strong about it, go ahead. Or, but this was like a no, absolutely not. Run for the hills. Like, you got to be kidding me. I'm not saying they're either crooks or they're highly incompetent. It's one of the two. There's no way you should have a pitch deck for an apartment building deal and you're not telling the investor what the debt is. I mean, that's unexcusable. And then to not tell them what the acquisition fee or disposition fee or the asset management fees are, it's just completely inexcusable. But a newer investor might not know that. You could get lured in with drone photos and videos and fancy names, and they're showing you before and after what they think it's going to be, and they're going to tell you 25% internal rates of return, and you're going to make 2.5 times your money in 5 years, and you sign me up, take my money. That's unfortunately what happens to a lot of new investors.
Yeah, it's you do really have to be careful. I think it's a great investment vehicle and a very should be generally safe and reliable, probably realistically more so than a lot of other asset classes, but still you do need to do your homework and need to know kind of what you're getting into. Well, let me switch gears here.
Oh, please.
I want to kind of get to the part where we get to ask you questions, the questions that I ask each guest. First one is related to the name of the show being Know Your Why. So Andy, what is your why? What sort of drives you in life? What's your motivator behind your success?
Oh, okay. I mean, for me, it's all about family, but it's from a generational perspective. So my great grandfather owned a liquor store in Minnesota, was a liquor distributor. Then my mom's father owned an army surplus store. My father owned a court reporting store. So it's generations of entrepreneurs. I work with my father now. He's a workaholic. He'll be 84 in January, and he still works more hours than most people. That's amazing. It drives me nuts sometimes. We were just screaming at each other this morning when we go to lunch. We can fight and still go to lunch.
Yeah.
It drives me nuts. But a very sharp man. He's forgotten more at 84 than most people know, let's just say.
Sure.
Much of the money that I'm investing, not all of it, but a good portion of it is legacy money, from my predecessors. I take it very seriously, that kind of money. There's a lot of responsibility to that. I've never actually touched any of that money myself, to be honest. That's all for my son. And I always tell my son, that's not for you. That's, for your kids, or that's for future generations.
Yeah.
Being a steward of family wealth is a very, important thing. So for everything I'm doing is like, I look at a BMW and I think, I'm not buying that. I'd rather do one more syndication deal.
Yeah.
I'm looking at that going, yeah, I can buy it. I'll go in with a really good industrial guy who's going to buy a 50,000 square foot warehouse in, Kansas City. The cash flows right away, and I'm going to collect, 5 years of distributions, and we're going to make money at the end, and I'm going to get tax benefits. Like, sign me up every day, twice on Sunday. That's how my life runs. I mean, you'll see, it's a polo shirt that I probably bought it at Sam's Club or Costco. I drive a Honda. That's not my why. Is going to be my family.
Yeah. I'm totally there with you. And I think I think one of maybe the most powerful thing in any type of investing, real estate especially, but is time. And if you're talking about generational wealth across yourself, your son, your son's children, like that's now you're talking about that time being so powerful. And it's like, yeah, you tell your son you're not going to touch this, but the fact is as that grows with all that time, is like, if it's treated right, everybody can eat, like the base money can stay right there, and you're just kind of get to the point where you really can live off that cash flow. So yeah, I think that's maybe one of the things that excites me the most, is talking to young people and guiding them towards investing, but also like thinking about my kids, and when I can, what I can do to teach them about this early in their life, that they can really, it'll set them up there. I didn't really get into it seriously until I was in my 40s, and I just feel like I'm playing catch up. So my my kids, the biggest thing I can do for them is just teach them. I don't know. It's not even that. It's not leaving them money. It's teaching them how this works.
When they're in their 20s, house hacking is just an incredible concept.
Yeah. There's so many
obviously for guys like us, we're in our 40s. The idea of house hacking is just not appealing, with a wife and family. But when you're in your 20s and singles, house hacking is awesome.
Yep. Yeah. There's just so many ways for them to kind of just manipulate their finances in a way to get themselves ahead and live well within your means, and don't get caught up in all that silliness. Second question for you: what is something about you that people, it may not be common knowledge, special skill, a hobby, just something that you're comfortable sharing that lets people get to know you a little bit better?
It's a really tough question. I'm not the most interesting person, I'll be honest with you. I wake up early and I work in real estate. Then I go to work early, and I'm there into the evening, and a lot of times work is still calling me in the evening. And I'm pretty much either watching YouTube, catching up on LinkedIn, even nighttime meetings. That's my life. Like, this is all I do. Like, this is a very serious time commitment. I tease myself because I'm supposed to be creating financial freedom and all this, but I basically created a job for myself as a portfolio manager. So, I have so many investments that, my God, tax time comes around and I'm ready to strangle myself. It's not fun. There's so many investments to go through, so many K1s or so many things to report to a CPA, but I like it. That's what I've been doing, for most of my life. I've been investing since I was young. This is what I enjoy. So this is what I'm doing. Like, I don't watch football games. I don't watch network TV. Like, I could talk to you 3 hours on the phone, and we could talk about, yield curve inversions, and I would love it. That's my whole, life. Like, we could talk about household survey versus establishment survey for BLS data. And, You know, you and I could talk for an hour. I'd have a good time. As horrible as that sounds, that what you see is really what you get. I really am just that boring and driven.
It's yeah, but you say bore. I think if that's your passion, right? Like if
Well,
you're
for me, I find it fascinating, but I mean, from the
exactly right,
outside
it's
world, I
yeah,
mean, my wife thinks I must be the most boring man on earth. You know,
your passion. If your work is your passion, like, are you really
it's not
working?
work.
That's kind of
Yes,
then
exactly.
it's
Yeah,
you're
you
just
get it.
doing
If you
something you
like
enjoy.
what you're doing, it's an avocation. It's no longer work.
Right.
You know, work is doing what you hate because you have to, and because you have rent to pay or something. I mean, I'm not, you know, I'm 47, and I've had a lot of significant, you know, advantages and privileges in life. But you know, one of my goals is to always make sure my son, you know, future generations, they're doing what they love doing, and they're, you know, it's profitable, yes, but it's, you know, improving the society. So
Yeah.
when you're doing a value add, this is a tangent, but I hate when somebody says value add and they're saying, well, I'm going to jack up the rents because the old owner didn't know what the market was. That's not a value add. You're exploiting a market inefficiency. I'm not saying it's bad or good. I'm just, that's what it is. Let's just call it what it is, that you're exploiting a market inefficiency. That's fine. A value add is when tenants come up to the property manager's office and say, thank you. Thank you for resurfacing the pool deck so my kids don't trip and hurt themselves. Thank you for fixing all the equipment in the gym. I can actually go and get a workout now and not be on a, you know, bicycle that's doing this. You
Right.
know, thank you for putting up security cameras. I don't think I'm going to get robbed as much. Like investors in real estate, it really is truly, you are doing a real service. We're not just flipping apartment buildings, you know, slap a coat of paint on and, you know, make our money and run. Most syndicators really do care about the community and the tenants that they work in. It's great to make money, but it works both ways. You can make money and better the world. I mean, if the buildings were left to their own devices, you know, they fall apart. You know, the elevator needs to be fixed. Those carpets got to get replaced at some point, you know?
Right. Right. Yeah. Totally agree. When people hear this and they want to reach out to you, what's the best way?
Best thing to do is get me on LinkedIn. Pretty easy to find. I'm most active on LinkedIn. You know, I'm on all the major platforms, but you know, I don't really enjoy Facebook and Instagram so much, but you know, I do it. You know, I do a little bit of Twitter, but it's not real. It's more of an after. LinkedIn's really where I am, and particularly within the syndication world. If that's what you're interested in, that's where most of the players really are. They're going to be on LinkedIn, because they're looking for white collar professionals, business owners, people with a certain level of income and net worth that are going to be able to invest, you know, $50,000 into a syndication deal. Most deals, the minimum is going to be 50,000. Some deals it could be 75. There's some that are going to be 100. It might go to 250, but generally speaking, most bread and butter deals are going to be about $50,000. And for a lot of people, that's a lot of money, obviously. You know, so it's okay if you know, you got to start out wholesaling, you know, got a side hustle, buying a, you know, a condo, buying a house, and you know, you and your buddy are going to do most of the repair work. Do whatever you got to do that. But there's a stage in the process where most people don't stay flippers for forever. Most people do flipping to build up enough capital, and then they want to do something else. The hours and the risks, you know, wear people out. So there's like a life cycle of investors. So when you're ready to come into commercial real estate and you think it's a good fit for you, call me up, and I'm very open. You can see the personality. You tell me what you want. I ask you a couple of questions. I'll put you in touch with people I know, and I don't get any kickbacks. I only do it just because I enjoy it. I'm not, you know, I don't get a referral fee or anything. I'm not getting any financial compensation for it.
Yeah. Great. Great. I mean, that's a nice, I mean, very generous to offer that to people because those connections and recommendations are very important.
Yeah, I mean,
Um,
it's kind of a pay it forward aspect of,
yeah.
there's many people that have been incredibly generous and helpful to me. So it'd just be highly disingenuous of me not to to be disrespectful to them and not show the same courtesy, obviously, because I've been very fortunate. I've had really, really wonderful people, much higher level, take an interest in me and help me out. So obviously, I need to pay it forward. So one of the ways we do it is I have my own podcast called the CRE Spotlight, and we just pick guests that we like, for that podcast. And a lot of it is like when I meet a younger syndicator, they're kind of trying to break their teeth into the business. They're new, and in particular if they're doing a unique concept, we'll try to get them onto the show. So like one gentleman was doing short-term rentals specifically in Yellowstone National Park, very specific niche. I was like, hey, why don't you come on the show? We'll try to get you a little bit, more visibility. Another young guy doing great things was doing co-working spaces, luxury co-working spaces in California. And it's a very unique concept. So I was like, you know what, why don't we get you on the show and get you some visibility? A bunch of other people called me up and said, hey, I want to be on the show. And I was like, really? Why? You know what they said? We want to help you. That's really how commercial real estate works. It's really about the network. I cannot stress enough how important the network effect is within real estate. It is all about relationships. The best deals you're going to get from referrals. The best loan you're going to get through a referral. The best broker, you're only going to meet them through a referral. You're not going to call them up out of the blue. They're not going to probably even return your phone call. Let's just be honest. Like the best brokers, you're only going to meet them because of a referral, or you became their friend through an event or something. But I cannot stress enough the relationships. So similarly, we started a Sunday meetup. There's a lot of Zoom meetups. We started our own, so it's the second Sunday of the month. So we have one coming up. We do it at 1:00 Central. So we have a speaker come for a half hour, and they help educate the audience. And we do several hours of breakout rooms, depending on how long people want to stay. We'll do 4 or 5 people in a room, and people introduce themselves and say, this is what I need help with, and people try to help them. We do that once a month. Christina Stevens and she's a really successful investor, and she's starting to become a real estate syndicator herself, doing many aspects. We started as a way to help people. And a lot of people that come to the call, they don't necessarily need help. They like it. They like helping people. They like talking to people. They like hearing, hey, what are you doing? You're a capital raiser. What market are you looking at? Hey, have you met so-and-so? Hey, let me connect you. That's really how commercial real estate works. It's great to be good at a spreadsheet. It's great to be a data analyst, and you're knowing all the migration trends and everything. That's good. But I just cannot stress enough how much of the business is relationships. And that's why, going back to what's the most important aspect of a syndication, it's the team. Because the right team is going to have all these relationships, so they're getting the best deals. They're working with the best broker. They're hiring the best property manager. It's all because of the relationships.
Yes, absolutely. Interestingly, generally, the last question I ask people is, what's one piece of advice you would give to someone starting in real estate? I feel like you just answered it. You already knew the question. You already had your answer prepared.
If anyone was following my LinkedIn account for any length of time, there's one rant I'm always getting teased about amongst my friends. They tease me quite a lot about it. Is I'm always pounding this thing. It's like, it's great to watch podcasts. I watch it. Everybody I know, even the most successful guys, they're watching podcasts. Yeah. There's only so much podcasts they watch. Everyone's reading books. I'm talking about like the guys worth tens of millions of dollars. They're still reading books. They're ferocious about wanting to learn, but they don't read too much. At some point, you gotta act. This idea of, well, I'm waiting for the perfect time. Well, in the last 2 years, sure, all of a sudden real estate prices are coming down some. People are worried about a crash. People are worried about a recession. Oh my God, what is Jerome Powell going to do? Well, that's all good, but your money sat in a bank account losing 8% CPI. You lost money the last 2 years sitting on cash. Yep. Myself, we bought properties. They've gone up. They're going back down, but they're up. We've collected rent all that time. I've got bonus depreciation on my syndication deals, and I've got depreciation. So most of my investments, we're not paying any tax.
Yeah.
So go buy a bond yielding 4% and go lose money in real terms. More power to you. I'm laughing my rear end off. You're worried about a crash and I'm making money. It sounds crass. I don't mean it to be arrogant or rude about it, but the people making money are the people in the game.
Yeah.
Even in the worst economies, there's deals. It's a highly inefficient market. There's always properties that come under distress. Owner died, owner's getting divorced. The bank called them up and said, hey, you owe us money. Like, you're out. You're out. Like, we're taking the property back. I'm calling up Jason and saying, Jason, you borrowed money from us on 5 other properties. You always pay us. Do you want to take over this property? That's going to be coming up in the next 2 years, in my view. A lot of the guys I talked to, they're very excited about distress coming, but it's not an excuse to go sit on the couch, eat Cheetos, or, paralysis by analysis. I guess that's the, expression everyone's heard. Everybody goes to that social party with, Uncle Bill. Uncle Bill drives a crappy car and he still lives in a townhouse, but he's the, world's renowned expert on every investment. And he's always bought at the peak, and he's sold at the peak, and he, bought at the absolute lowest. But oddly enough, he's, broke and hates his job, and he's still working a W-2, but he's always busting you, telling you how, he knew that this was the bad year to buy real estate. Everybody's got an Uncle Bill in their life, or a coworker, God forbid, a wife or a father-in-law like Uncle Bill. You got to get rid of the bills in your life.
Yeah. No, I think it's all great advice. Listen, this has been awesome. Thank you for coming on and
we're a little over the hours.
Oh, it's fine. I don't really have I don't have a hard stop unless there's something behind it. But no, I'm happy that we got to go through this. I think there's a lot of really just actionable things for people, particularly from a passive investor standpoint, things to look for and all of that. So thank you for coming on and sharing all of your wisdom. Appreciate it very much.
Oh, really appreciate you. Thank you so much for the opportunity. It's quite an honor. Really appreciate it. Thank you so much.
Yeah, absolutely. Folks, when you're listening, I'm sure you're going to love this episode, but please like, rate, and review so that we can get more listeners and or more reach and more great guests like Andy Rosenberg. All right, take care.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.